because the entry level market has not been addressed for a decade and a half. Builders simply aren't building enough cheap homes. And why aren't they? Well, number one, they can't make much money on them because, they've got a very low, slim margin to build an economy car. Okay, what they want to do is sell luxury cars. I mean, what do you think the profit margin is on a Rolls Royce versus the cheapest Toyota, right?
Welcome back to Capital Cosmo, everybody. Today, I have the great pleasure of talking to Jason Hartman. Jason, thank you so much for coming on, my friend.
It's good to be here.
Before we get started, I'd like to remind everyone to hit that subscribe button if you're enjoying this content. If you're getting value out of these videos, it takes less than a second, and it's right there. It's right there in the corner. So hit that subscribe button. Okay, Jason, let's go ahead and dive right in. It is your maiden voyage on the show, so it's customary for me to ask you, who is Jason Hartman? What got you into investing? What got you into real estate, commodities, the gambit? Kind of give us your origin story.
I'll tell you all of that, but I first want to say, where is Jason Hartman?
Okay.
Because I'm in a hotel room here in St. Moritz, Switzerland. So that's why you see the different background and the very mediocre lighting. If you could even say it's as good as mediocre, I don't know, might be worse than that. So anyway, I'm kind of recording from my trip. I'm spending the summer in Europe and just traveling around a bit. Doing some different things. I got into the real estate business my first year of college. I started selling real estate. But really the reason I did that is I wanted to be an investor. And I, after growing up poor in Los Angeles, California, didn't like being poor too much. I kind of figured out that it was a good thing to earn money. And so that attracted me to real estate. And all these years later, I still think it is the most historically proven asset class in the entire world. But interestingly, and I know you talk about this a bit, I'm really a commodities investor, and I'm going to explain that for you during this show. So when you're ready, we can touch on that.
Let's just go ahead and take it away. How does real estate tie into the commodities market?
Sure. Well, I created a strategy many years ago I call packaged commodities investing. Because if you think about it, when you buy a property, right, you buy an income property, you're really buying two things. You're buying the land, and then you're buying the house sitting on the land or the apartment complex sitting on the land or whatever, right? And I like investing in low land value markets, and they have a high improvement value or structure value as a percentage of the overall equation. So if you bought property in an expensive market, like where I grew up, Los Angeles, California, for example, okay, there you would be paying mostly for land, and a very small part of the equation would be for the improvement, the house sitting on the land. But in these low land value markets that make a lot more sense to invest in, you're buying mostly structure, mostly improvement value. And if you think about it, what are the ingredients of the improvement? So I'm in this hotel room in beautiful St. Moritz right now, and behind me, you see windows, you see glass, okay? Above me, you see drywall. In those walls, you see in the flooring and everything, right? The ingredients of the house, wood, their lumber, petroleum products, copper wire in the walls, glass, steel, concrete, energy, and certainly labor, okay? So all of these ingredients of a house are commodities that are not attached to any one currency. They're traded globally, and every human on earth needs them because every human on earth needs shelter. Okay. And so it doesn't matter if you trade them in the yen or the euro or the peso or the Brazilian real. I don't care, right? They have intrinsic value. And that's what I love about commodities. So instead of going to the commodities exchange and buying the commodities, I like to buy them in a packaged way. And I actually trademarked that term, packaged commodities investing, because when they're packaged in the form of a house, then they get the real estate label on them. And with that label, Danny, comes a lot of huge benefits, huge tax benefits, fantastic 30-year long financing at super low rates. And I know everybody's thinking, oh, when did the guy record this? The rates aren't low anymore. Yeah, they are low historically. And compared to what? Compared to the real rate of inflation, rates are actually pretty low, even now. I know after we've had these, we just got spoiled, right? We had this little blip of time during the COVID era where rates were insanely low. They're still relatively low compared to inflation. Okay. And so, you get a lot of special characteristics when you are a commodities investor in packaged commodities investing.
Yeah. So I want to kind of hone in on that inflation story for a bit. What would you say is the real rate of inflation? I know Shadow Stats typically has it around 7% or so, despite the CPI being at around 3%. But how do you determine what would you say is the actual rate of inflation?
Yeah, John Williams, the founder of Shadow Stats, has been on my show before, and he's one of many people that have opinions on the real inflation rate. And what he's doing is he's just calculating inflation the way they used to calculate inflation, the government. The Consumer Price Index, the most widely used index for inflation, got highly manipulated around late 70s, early 80s, when the inflation rate was very high. They started really, really manipulating the index. So it is not reliable. The three major ways it's manipulated are through weighting, substitution, and hedonic indexing. So let me just give brief examples of those things. Weighting, the CPI is a basket of goods. So different things in that basket can be weighted differently, and therefore it influences the overall rate of inflation in the basket of goods. So weighting is one way they manipulate the index down to make us think inflation is lower than it really is. Substitution is another way, and that basically says this: if the price of beef goes up, they just assume everybody will switch to chicken. And so they substitute. And maybe you don't like chicken, maybe you think chicken's a dirty bird and you don't want to eat chicken, you want to eat beef, and so they'll substitute. And then hedonic indexing actually does have some logic behind it. It comes from the root word of hedonism, pleasure seeking. And so, if you look at my phone here, for example, this phone costs $1,500, and my first cell phone cost $3,200, and it was much worse than this one. This is dramatically better than my first cell phone, and so what they will do is they will say, well, how much pleasure does someone get out of an item? And we're going to assume that the new item, if it's twice as good as the last version, only cost half as much. But it didn't cost half as much. Okay, that's the problem. And even though there is some rationale to that, what it really says is that we as people, Danny, aren't entitled to progress. Can you imagine if they hedonically indexed everything since the invention of the wheel or the electric light bulb? Everything would be free.
You can use their own logic against them. They don't hedonically adjust their substitutions. So if you're substituting ribeye steak with chicken breast, hedonically adjusted, that should be a decrease in living standard, right?
Yeah. No, you're right about that. And so I call the CPI, the most widely used measure of inflation, I call it the CP lie. Okay, because it is a lie. So your question, sorry for the long answer, your question was, what is the real rate of inflation? Well, it depends on each of us, because we all have our own inflation rate depending on how we spend, because we all spend differently, right? Here I am in St. Moritz, Switzerland, okay, which is a very high-end luxurious place, and everything here is insanely expensive. But in proportion to my income, I do care because I just think it's a ripoff, okay? But I don't really care. But if you were someone, with a normal job, making the median income in the United States, and you came here, you would just be aghast at how overpriced everything is. A 5-minute ride in a taxi costs $30. Well, no, 30 Swiss francs. Okay. It costs more than $30 US. It's probably about 35 US dollars. So it's insanely expensive here, right? And so, we all spend differently. So we all have a different rate of inflation. But I would say to be safe, on, on average, you could argue pretty successfully that right now, the stated inflation rate of about 3%, it's been going down. Okay. They love to say, good job, Jerome Powell, government, everything, inflation's coming down, Biden, whatever. But you could safely say the inflation rate is almost double that, 5-6% pretty easily, and probably a lot more. Because if you look at the cost of healthcare, of college tuition, and certainly housing, okay, the inflation rate is off the charts.
Yeah, I think any person that consumes energy or eats food or is alive would agree with you there, Jason. Let's go ahead and get your
Well,
overall
by the
view.
way, by the way, Danny, I'll just comment on that
Yeah,
real quickly. So, in addition to the CPI, okay, the Consumer Price Index, they also created another thing to lie even more, and they call it the core
yeah,
rate or headline inflation. And what they do there is they take the CPI and they strip out two things that you just mentioned, food and energy. Now, I don't know about you, but nobody can live without food and energy because the cost of energy is in everything and we all need to eat. Okay, so the core rate or headline inflation is another way to just massively lie and understate the real situation we're in. Now, it begs the question too, why would they lie? Yeah, I mean, look, the Bureau of Labor
mm,
Statistics tells us the inflation rate. Okay. What would be their incentive to lie to us? Well, they have two major incentives, if you ask me. Number one is they just generally want to keep the people happy, so they don't whip out the pitchforks and revolt. Okay, you always want to keep the peasants happy, right? That's any ruler throughout history will tell you that. But number two is a lot of the government entitlement programs, and also since the government is about 20% of the overall economy now, they employ so many people. The government salaries and pensions and all of this stuff, they're indexed to inflation. So if they understate the rate of inflation, they don't have to spend as much money.
and I'd add a third item to your list there, and it's also taxation, the taxation brackets, right? So they
Right.
inflation
Yep.
adjust the taxation brackets. So like if you're making $100,000 in the year 2000, it's not the same as making $100,000 in the year 2024,
Right.
but you're still
Yeah.
they move the brackets up, adjusted by inflation. But if the inflation rate is underreported, then you're effectively paying a higher tax bracket in real terms for a salary or an income that doesn't keep pace with it.
Yeah, so let me say that another way because that's really smart that you brought that up. I'm glad you did. What they do is they basically look, inflation is an insidious hidden tax, okay, that steals your wealth. All right. Now, we're going to talk about how to win the inflation game in a moment here, okay? But it debases the value of our savings, our stocks, our bonds. It makes us get poorer, right? But what you talked about is very, very observant because what it also does is they can not raise taxes and still raise taxes. What do I mean by that? It's just what you were saying. Basically, if there's more inflation than they lead us to believe, all of the marginal tax brackets can stay the same. They don't have to raise taxes. But if you're getting paid more, because it's really the same as what you used to get paid, it has the same buying power. You didn't get any richer, but it kicked you up into a higher tax bracket where you're paying a higher percentage of your income in taxes. So that's how they raise taxes without raising taxes. The whole thing's a complete scam.
Yeah. Yeah. So let's go ahead and shift over to real estate for a second. What's your overall view on real estate? I really got to give it to you, Jason. I need to give you your flowers here. I first discovered you back in the year 2000. And I was, 2020, not 2000, 2020. And, we were in the midst of COVID and we had a big real estate boom back then. Prices were going sky high. I was fighting with trying to find a house, fighting with 10 other bidders on the same house multiple times. And I remember hearing so many people talk about a crash in real estate. It's going to crash any day
Yeah.
now. But you and maybe a few other people, you were kind of like the lone voices out there saying that there wasn't a crash and that real estate was one of the best investments you could make, especially back then. You're looking at rates between 2.5% to 3%.
Oh my God.
Luckily, I listened to a lot of the points that you made, and I locked in my 3%. And despite not buying at the very low, but I still bought at a price that many would kill for today. So I
Yeah.
want you to talk about real estate. What do you see happening in the real estate market? Where do you see it going forward? Are we heading towards a crash or not?
Yeah.
Yeah, let's go through real estate. Hey guys, quick pause. Are you looking for a new stock trading app or just want to diversify where you put your money? Maybe you want a plan B, a plan C when it comes to your stock brokerage apps. Well, I've got a special offer for you. It's from Moomoo, and you get a special 8.1% APY on uninvested cash. That's right, 8.1% APY. And if you deposit $100, then you get 5 free stocks. If you deposit $1,000, then you get 10 extra free stocks for a grand total of 15 free stocks potentially, depending on how much you deposit. This won't be here forever though, so be sure to claim your offer now. Link to that is down below. Moomoo has all of the amenities of your typical stock trading app. 100 plus technical analysis and drawing tools, 0 commission, 6.8% margin rate, 0 equity option contract fee, and more. So check them out, link down below, and let's get back to the video.
Couple things I want to say before I tackle that big question. Number one is that anybody who thinks the game of real estate investing is simply about buy low, sell high is a very shallow person that has a very minor understanding of the whole game. Remember, with income property, it's a beautiful multi-dimensional asset class. So you make money a lot of different ways. Okay. It's not just, look, with a non-dividend paying stock, with cryptocurrency, with precious metals, with many types of assets, they're one dimensional. The whole story is buy low, sell high. End of discussion. Okay. If the stock pays dividends, it's buy low, sell high, get some dividends, two-dimensional. Okay. Income property has at least 6 dimensions, sorts of different ways. I mean, you could have the property go down in value and still make money. I mean, that happens all the time. Okay. And so the first thing I want to say there is don't be the person that thinks the whole game is about speculating on prices. There's way more to it than that. And so that's the first thing to know. But what do I think? I think we have a massive housing shortage in the United States that is going to continue for many, many years. And everybody out there talking about numbers, whether they mislead or lie or don't understand them or do understand them, okay? They're talking about aggregate overall housing numbers, and they're not segmenting by price, which is incredibly important. So just if you look at the market overall right now, we have about 140 million units in the housing stock of the country for 340 million people. That's how many houses we have, right? About 140 million. And currently for sale is less than 0.5% of the entire housing stock in the country.
Wow. Which
is insanely low. It's only about 650,000 housing units for sale right now. In 2015, we had about 1.2 million housing units for sale. Now, I want to say something here because it's important that people don't say, well, Jason, you're quoting the wrong numbers. No, I'm not quoting the wrong numbers. There are different studies that compute those numbers differently. Okay, so some studies include active listings, pending home sales, meaning they're in escrow under contract, but they still call them available, and contingent sales, where the buyer has to remove a contingency for the deal to go forward. To me, those are not available, those other two assets, right? Pending and contingent is not for sale, okay? Only active listings are actually for sale. So that's the number I'm giving you. Now, if you want to use, for example, NAR's number, which includes those, okay, you can do that as long as you compare apples to apples over time. The proportions are about the same. no matter what. Okay. But I'm just talking about active listings when I say that. Okay. So about 650,000 units for sale right now. The old idea of what is normal is about 1.2 million units. But the problem is that idea of normality was created almost 9 years ago. Well, really 9 years ago, when the population of the country was lower and the housing and the overall housing stock was lower too. So I would say that to be in a quote unquote normal market, we need about 1.4 million homes for sale at any given time, which would equal about 1% of the housing stock of the country should be for sale at any given time. We have less than half of that for sale. Now, that's overall. But when you segment by price, it is so much more acutely worse in the entry-level housing segment, because the entry-level market has not been addressed for a decade and a half. Builders simply aren't building enough cheap homes. And why aren't they? Well, number one, they can't make much money on them because they've got a very low, slim margin to build an economy car. Okay. What they want to do is sell luxury cars. I mean, what do you think the profit margin is on a Rolls Royce versus the cheapest Toyota, right? Of course, when you sell a Rolls Royce, you're going to make way more money. You sell a $470,000 Rolls Royce, they're going to make way more money than they're going to make on a cheap $23,000 Toyota, right? The cheapest one you could probably buy, right? And so builders want to build the more expensive houses. And they just can't afford to build the inexpensive houses anymore because there's just not enough profit margin in them. So they're not building for that market. And that's the market we as investors like. My company, Empowered Investor, basically helps people buy properties in markets nationwide where we've looked at these markets and we think they make a lot of sense. There are these good, solid, linear markets where the land value is low and the construction or improvement cost is high as a ratio of the property. And so we like markets in Alabama, Tennessee, some in Florida. Some in Florida are getting a little high on the inventory side, but still not even high enough to be normal. Okay. By the way, one metaphor that I use, Danny, that's helped a lot of people, they say they really like this metaphor about the marketplace, is this. If everybody listening or watching will just visualize for a second their kitchen sink. Okay. Visualize your kitchen sink. What's it look like, right? Stainless steel, porcelain, whatever, right? So if your kitchen sink were full of water, you plugged the drain and filled it to the brim with water. If that was considered a normal market, okay, we would have 1.4 million housing units or so, okay, in a normal market. Right now, that sink is less than half full. That's where the market is. Now, the faucet represents new properties coming onto the market, new listings coming up for sale, people wanting to sell. The faucet is just at a trickle. The water's barely coming out. And since rates went up, demand has declined because housing affordability is terrible. It's the worst it's been in 40 years. It's very hard to afford a house now. So the demand is the drain. That's what is the absorption rate? How many properties are these people buying? That's the drain in the sink. The drain's a little plugged up. During the COVID era, the drain was like wide open. In fact, they drilled another drain in the bottom of that sink. Everybody was buying everything. Right now, the drain is about 25% plugged up. The new inventory, the sellers just don't want to sell because their deal is too good, just like your deal on that great mortgage you got because you followed my advice.
Yeah, I heard you mention linear markets. Talk us through define linear markets, define cyclical markets, and define hybrid markets. A lot of the people who may listen to the show may not be familiar with those terms.
Yeah, so for the past 21 years or so, I've been teaching people how to invest in real estate. And one of the things I was talking about back in 2003 was the difference. Look, we live in a huge country in the United States, if you're in the US, and the US has 340 million people. It's got over 400, well, it's got about 400 what they consider metropolitan areas. It's got over 3,100 counties, over 9,000 cities. Okay. There is no such thing as a national real estate market in the United States. All real estate is local. All real estate is local. But to make it easy, you can divide every market, not just in the US, but around the world. Okay. And I've been to now 94 countries, and I've, at least in about 40% of those, I've spent serious time looking at real estate deals in those markets. I'm in Europe all summer. I'll visit several countries here. And you can divide them up into three types: linear markets, cyclical markets, and hybrid markets. So what are those? Well, if you look at a chart of real estate appreciation through time, just visualize like a chart, okay? And a cyclical market, the markets that get most of the attention, the markets everybody's talking about, that chart, Danny, would look like a roller coaster. Glorious highs, ugly lows, then you go up a hill again, then you go down. It's a roller coaster ride, okay? And that's a cyclical market. So what are the cyclical markets? Well, there's not that many of them in the country or around the world, but they do get all the attention because they're considered the trophy markets. So the West Coast of the United States, almost the entire coast is cyclical. Okay, Los Angeles, San Diego, LA, Orange County, Seattle, everything, right? It's pretty cyclical. The expensive northeastern markets, New York, Washington, D.C., Boston, right? Cyclical. Where I lived before I, sold my house was South Florida, Palm Beach. Okay, that's a cyclical market. Miami, Palm Beach, that's South Florida. Any expensive market is going to be cyclical. Around the world, Paris, London, Dubai, Hong Kong, cyclical markets. Okay, these are the trophy markets of the world. But these markets suck to invest in. You've got to be a gambler. They're very speculative, and the cash flow never works because the prices are way too high in relation to the rent you can get on those properties. So cyclical markets do not work for investors. They only work for gamblers and speculators. And, I've gambled and speculated and I've made money sometimes, but you could also lose a lot. So be careful. A linear market is a market I like. This is a market where you're looking at that chart and it just kind of goes along. It's pretty boring. It has some little ups, little downs, little ups, little downs, but it's pretty dependable that it's just appreciating slowly. And that's the linear market. That's almost the rest of the entire country, right? And almost the rest of the entire world. Most of the world, most of the US is all linear, right? But it doesn't get much attention because it's boring. It's not newsworthy. Hybrid is in between the two, as the name would imply. What are hybrid markets in the US? I'll just give you a couple examples. Okay. Austin, Texas, hybrid. Denver, Colorado, hybrid market. Where you live now, Atlanta. I think you're in Atlanta, right? Mm-hmm. That is now a hybrid market. Okay. We would have called Atlanta, and we've helped people buy a lot of properties in Atlanta over the years. Okay. We would have called that a linear market years ago. But after the last run-ups, it became what I'd consider to be a hybrid market now.
What makes it a hybrid market now, as opposed to like say 10 years ago?
Linear and cyclical.
Okay.
Yeah. So it became more cyclical. Okay. On the last run-up. Atlanta became a highly desirable market. And so, whereas before nothing too exciting happened there, it was just kind of linear, it chugged along. But it's certainly not Los Angeles, like a total roller coaster. It's in between. It's like a boring roller coaster, but it's still a roller coaster.
So do you still...
Maybe it's the kids' ride, the kids' version of a roller coaster rather than the adults' version.
Yeah, totally. So do you still see opportunity in these cyclical markets, though? Given your prognosis of the real estate market at large, do you still see opportunity in these cyclical markets? LA, San Francisco, New York, etc. Do you still consider them cheap?
Well, there will be at times. But I don't like those markets at all. I mean, I wouldn't invest in them. They're very risky. Look, there's a difference between being an investor and a speculator or a gambler. Okay. If you're betting just on appreciation to make your deal work, the appreciation might not come. With our deals, they don't have to appreciate. Okay, we're going to make money no matter what, right? Well, I mean, look at it, it's not perfect. There's no guarantees of anything in life, but in these good, solid linear markets, you're investing for stability and cash flow versus speculation on something extraordinary having to happen to make money, like appreciation.
Yeah. So we have this election coming up, presumably in November. It
Presumably,
does,
it's called an election.
yeah, presumably as well. Do you see, does the outcome of the election impact the real estate market or the economy at large in your mind at all? And if so, what would be the main differences between a Trump part two presidency or a Biden part two, or whoever they insert in the Democrat slot?
Yeah, right, right. And it's going to be really interesting on the Democrat side because, wow, I can't wait to see what happens there. It's going to be fascinating. If Trump wins, that will definitely instill a more business-friendly, bullish mentality into investors, and I would think it's very bullish for real estate. If Biden wins, that's going to be very bullish for inflation. And so, like, do I care as an investor? Not really, because I love inflation. I mean, I trademarked the term inflation-induced debt destruction that you hear me talk about all the time because you make so much money with inflation. It's just an incredible thing. But philosophically, I think it's a terrible thing. Okay, it's not good for the country. It's not good for most people. Um, I just know how to make it work for me, and that's what I teach our investors. That inflation benefits you in a huge way. I call it the double inflation arbitrage.
Yeah. I want to shift back a little bit now to identifying opportunities in real estate. One of the key metrics that I learned from you, Jason, is the rent to value ratio, the RV ratio, and determining whether a piece of property is cheap, expensive, or fairly priced.
Mhm.
Can you explain what the rent to value ratio is, and if there's any other measures that that the average person out there should know in terms of valuing real estate?
Yeah, of course. So the rent to value ratio is just a really quick rule of thumb. Okay, that's all it is. It's very quickie analysis. Basically, what it says is that ideally, you would like to get, if you can, which you pretty much can't anymore. So I'm going to just ruin it for you all there. Okay. You'd like to get 1% of the value of the property per month in rental income. So if you have a $300,000 property, ideally you get 3,000 a month. You're not going to get it in any quality property anymore because what always happens is the prices run up much faster than the rents. So they're always out of sync where rent increases are chasing prices. And we're in that period now. It takes about 3 years for those to kind of equalize. And so we've had a big run up in prices, as everybody knows, and now the rents are playing catch up, and we are seeing very significant rent increases even now. Now you might be thinking, well, Jason, that's not really true. Well, you got to look at the data, folks, more carefully, okay? Because that is true that rents have been somewhat anemic in the multifamily market, but that's not really true in the single family market, okay? Those are different, and it depends on the price range and the geography and a lot of other things, okay? That's why people like me make entire careers out of this, okay? Studying this in depth, peeling back all the layers of the onion. But ideally, try to get as close to 1% per month as possible, right? That's an ideal rent to value ratio. What's the lowest acceptable? Ideally 0.7% per month. What is the typical rent to value ratio in a cyclical market that we talked about earlier, where we don't like those markets? It's going to be 0.4. So,
Okay.
for example, in Los Angeles, you can go rent $1 million home for $4,000 a month. 0.4.
0.4%.
That's a very good deal for you as a renter. It's a terrible deal for the owner.
Yeah, so it's a good rule of thumb to use as arbitrage, whether you're in the shoes of a renter or in the shoes of an investor. What I've been doing lately, Jason, is I've been asking each of my guests to recommend a book or two that the audience should read to kind of deepen their knowledge in regards to what we just talked about, investing, real estate, commodities. Any books out there that you think people should pick up?
Oh gosh, there are so many. I go through about 200 books a year. Okay. And, a lot of them I do on audio because it's portable and I can be moving around while I love to walk. And so I'm like Forrest Gump, but with walking, not running. I just keep walking and I listen to a lot of audiobooks. But, I most recently, I'd say a good one would be The Psychology of Money by Morgan Housel. That
Okay.
book is really quite good. It's more about like stock market and stuff, but it's really about your psychology. I mean, he's a stock market guy, not a real estate guy, but what's important there is your psychology and how you deal with upsets in the market and things like that. There are so many good ones, though. Gosh, he's got another one called Same as Ever that I like. Uh, Lynn Alden's book Broken Money was pretty interesting, I thought. She's been on my show a few times. She's a friend of mine. Gosh, I'm kind of looking through my phone now to answer your question.
Yeah.
Um, there's literally hundreds of others I could mention, but anyway, there you go. There's a
Yeah,
couple.
we'll drop all those books and links down below, guys. If you're interested, check out the description down below for those links. Also, another thing we've been doing, Jason, is I've been opening the doors to my guests to ask my next guest a question. So if you could ask my next guest a question, any question, what would it be?
Hey, before I do that, I wanted to say when you asked about analysis a minute ago,
Sure.
and I used this great software for many years, and I liked it so much I bought the company.
Okay.
There's a commercial like that, and it's called Property Tracker, and it's free. And you can just go to propertytracker.com and get a free subscription. Just it's free. You don't need to pay for the upgraded version. And what you can do is in 5 minutes, you can do a whole pro forma and analyze. It's the best analysis software I've ever found. It's not the best at everything else, but property evaluation, it is the best. And just go get a free subscription at Property Tracker and learn
Okay.
how to analyze deals. That's what made me a really good investor was changing the scenarios, changing the numbers, changing the assumptions. I got really keen on the math of a real estate deal doing that. And it's very easy to do. So get a free subscription. Next question. Oh gosh, but I'd ask him about, what's the price of oil going to do?
Cool. So I actually have a question from my previous guest to you. So I recently interviewed Jay Martin, and he wants to know.
I mean, I have a lot of geopolitical analysts on my show right now who are forecasting the next American election to be the most consequential event in geopolitics of the year. I'd say this. I'd say, how do you make that decision? If you're concerned about the trajectory of civil unrest and populism and polarization, as I am, and my family's American Canadians, we have a bit of optionality where we live. We're having this conversation frequently in my household. Where should we locate? Where should we raise our kids? How do you make the call between staying put, fighting for what you believe in, or just maybe accepting that you can't change the course of history and it's time to put down roots somewhere else?
Oh, well, look, folks, this anti-US sentiment is irrational, if you ask me. I mean, all these people that are like leaving the country and this is nuts. I mean, this is just look, when Obama got elected, a lot of my Republican friends were like, "Oh my gosh, everything's going to hell in a handbasket." And I said, "Look, calm down. Yeah, I don't like Obama either, but it takes a long time to ruin a country this great. And they're trying." I mean, we're definitely on a downward path in many ways. I will not deny that. I completely agree. But, compared to what? I mean, I'm in Europe, okay, for a couple of months now, and I come every summer. And, the US, as far as money goes, there's no better place in the world than the United States. I mean, that mentality of people in the US is so resourceful. I cannot believe how just much more on their game a good American is compared to like anybody else in the world. Now, there's a lot of lame Americans for sure, but you get an American who's on their game, and they're pretty hard to compete with.
Yeah, 100%. Well, Jason, it's been a pleasure. Anything else you want to talk about before we wrap things up?
No, I just want to say that everybody, when they're thinking about their calculus of where to put their money and what to invest in, just understand we have a housing shortage that is almost impossible to fix because the government won't let anybody build cheap houses anymore. Okay. It's very expensive to build a house. And the entry level housing component of the market is very, very hard to solve and replace. And people need that basic housing. The population is going to be increasing for quite a few decades to come. It's not forever, but we've got quite a runway ahead of us. And people need houses, and you can supply that to them, lend them, rent it from you. It's the most historically proven asset class in the world. It's the most tax-favored asset class in America, and taxes are the largest expense most people have. So you want to be in the game of income property investing, and learn how to do it better. Get that free property tracker software, and you can follow my podcast, my YouTube channel. Just look up Jason Hartman anywhere, and you'll find me. And I just want to say happy investing to all of your followers.
Great. Any other socials you want to drop before we sign off?
No, that's it. Just Jason
Cool.
Hartman on any podcast platform or YouTube.
All right. If you guys enjoyed this content, be sure to leave us a like, comment down below. Go, Jason, go. Go, Jason, go in the comment section. Also, subscribe to the channel if you haven't already. 88% of you guys who watch the show are not subscribed yet. Go ahead and flip that ratio around. It takes less than a second. Hit that subscribe button, and I will catch you in the next episode. Bye, y'all.